everybody, and welcome to the very first episode of Compounding Everything. My name is Chris, and in this episode we're going to discuss COVID-19, the effect it's had on the economy and the stock market, and is now a good time to start buying shares? Stick around. At the time of filming this video, on Wednesday, the 1st of April 2020, COVID-19 has infected more than 787,000 people, with a mortality rate of 4.8%, resulting in 37,829 deaths across the globe. Obviously, this has sent a ripple throughout global markets, with markets selling off 35% from their highs, workforce cuts of up to 3.3 million in the US alone, and the travel economy halted, which in itself controls 10% of global GDP. Some estimates are showing that countries like the United States could have up to a 25% reduction in GDP over the next 2 quarters. As you can imagine, this could have a significant carry-on effect over the next couple of years. The general mentality of our leaders appears to be act fast and think big. Of course, the global risk markets went into full pandemonium mode. The VIX, more commonly known as the Fear Index, has seen unparalleled gains throughout this period. The higher the price of the VIX, the more likely we are to see short-term losses or volatility in the market. Some of the most significant securities affected were those in the travel, entertainment and hospitality industries. The largest leisure cruising company in the world, Carnival Cruises, lost 78% of its market valuation overnight, while Australia's largest travel agency, Flight Centre, lost an unbelievable 79% of its market cap within a matter of days. Nevertheless, travel companies weren't the only ones affected. Casinos, hotels, retail, property, and manufacturing were also sold down. Of course, this had a significant impact on global index funds. The Dow and the S&P 500, which track the largest 30 and 500 companies listed on the New York Stock Exchange, saw almost unprecedented vertical sell-offs. At one point, the Dow and the S&P 500 were sold off 35%. Alongside that, the Australian index fund ASX 200 saw its worst quarter in history, selling off more than 42%. Funds like the Australian Equity Strong Bear Hedge Fund, which hedges itself against the market, meaning that if the market goes up, that fund will go down, and if the market goes down, the fund will go up, saw well over 100% gains in the last 8 weeks. Alongside that, gold has also increased in value, as to be expected in times like this. There was, however, still a little green showing across the market, mainly your bread and butter downturn performers. Companies like Walmart, Amazon, Coles, Woolworths, Coca-Cola and McDonald's are all expected to do relatively well throughout this period. Well, firstly, what does this information actually tell us? It's obvious that in the short term, the economy and the stock market has been brought to its knees, and there's probably no way around that for at least the next couple of quarters. Now, everybody's going to have an opinion on what should happen next, and everybody has an opinion on how long this will last. But it really leads us to the question, which was the point of this video, which is, should we start buying stocks? There are 2 famous quotes I like to turn to when my mind sort of wanders away a little bit from my fundamental foundations. And maybe, hopefully, they'll help you as well. Both are from Warren Buffett. The first is time in the market beats time in the market. And the second is we simply attempt to be fearful when others are greedy, and greedy when others are fearful. I think these 2 quotes really help us understand what we are doing as long-term investors. If you're looking for short-term gains, maybe you're a day trader, maybe you're a swing trader, then sure, this is probably a difficult time for you, and maybe some of you are winning, and probably a lot of you are losing. But as a long-term investor, I'm not worried about what the market is really doing today. Of course, if it sells up 50%, I love that. That's great. That's what we want, because I want to buy more of what I like. The companies that I liked a year ago, or I liked 6 months ago, haven't changed. They are still the companies that I want to buy today. Now, of course, there may be some more hurdles in place in times like these. You might have to worry about if that company has the right amount of debt or can handle its cash flow over the next 6 to 12 months. Yes, we have lockdowns in place and things are going on. But you have to remember as a long-term investor that these are opportunities and that we have to be greedy when others are fearful. It's easy for somebody to think, should I sell? Oh no, am I going to lose money? And remembering that the tried and tested methods of long-term investors like Warren Buffett, who has had endless amounts of success following these rules, really helps you get through it. This leads on to the next most popular topic. And most mainstream media right now surrounding all of this drama that's happening in the stock market is really about, have we found the bottom yet? Everybody's trying to find that perfect entry point. Everybody's trying to predict what the market's going to do. Is it a V? Is it a U? Is it an L? The difficulty with trying to find the bottom of the market would be assuming that you have an ability to predict or time the market. And timing the market is probably the single biggest mistake a long-term investor can try and make. Unfortunately, nobody knows what the market is going to do, whether it be in 1 hour, 10 hours, or 100 hours. You can speculate, you can try and use evidence or logic reasonably to try and enhance your argument. You still don't know what the market is going to do tomorrow. None of us do. And that's okay. We don't need to. We just need a plan. So what can the average person do to profit during a downturn and reduce your risk? The first is dollar cost averaging, which is undoubtedly my favorite investing tool. This is probably the single most important and most valuable way to reduce your emotional risk short term while increasing the chance of lowering your financial losses long term. So what is dollar cost averaging? Dollar cost averaging is spreading out your entry point into a stock or security over a regular set period of time, with hopefully similar investment amounts over that same period of time. Now it sounds a little bit confusing, but let me give you an example. Let's use the $6,000 over 6 months example. Say an investor wants to put down money in company X, but its share price has been rather up and down lately. The investor decides to make use of dollar cost averaging over a 6-month period, investing $1,000 every month regardless of the share price. This is how it goes for the investor. In the first month, they will invest $1,000 at a share price of $8, purchasing them 125 units. In the second month, they will purchase another $1,000, but at this time the share price has gone down to $5, meaning they will purchase 200 units. Then in month 3, they will purchase another $1,000 worth of stock, and the share price has gone down even further to $4. So now they've purchased an additional 250 units in that company. Now in the fourth month, they will purchase another $1,000 worth of shares. However, this time they will get 500 units because the share price is 75% lower than where it originally was at $8. Now in the 5th and 6th months, they purchased another $1,000 worth of shares at $3.33 per unit and $6.66 per unit, landing them another 450 units. So, at the end of this period, you've invested $6,000, the average share price was $3.93, and you've got a total of 1,525 units owned in this company. Rather than investing the entire $6,000 in the first month and ending up at 750 units, the investor using dollar cost averaging has staggered the investment period over 6 months. And because the share price has moved up and down over that period, ended up buying 1,525 units. And while the price of the share price dropped as low as $2 at one point, at the end of the 6-month period, the share price was worth $6.66, meaning that the portfolio of 1,525 units is worth $10,156.50 at this time. If the investor had instead invested a large sum of money at the beginning of the period, the 750 units would have been worth $4,995, meaning the investor would have actually made a loss on the investment, obviously on paper, at that time. Keep in mind, however, that dollar cost averaging isn't always risk-free. If the market continues to go up and you were dollar cost averaging, you would end up having less units than you would have in this example if the share price wasn't going down. However, generally speaking, the reason that you will dollar cost average is because you are trying to limit your risk and limit your exposure to market volatility. If the share price continues to go up, that's fine. You've already decided that that's a company you'd like to invest in, and obviously you've allowed for a margin of safety in that purchase. So it's not a problem at all. Over the next couple of months, I will have a video dedicated completely to dollar cost averaging. So if you haven't already and you're enjoying the content, please feel free to subscribe and press that like button because it will really help the channel out. We're going to be posting weekly videos from this point forward discussing all things business, finance, and investing. Quickly, I'm going to take you through the top 3 reasons why you should have an emergency fund. So what are the top 3 reasons why you need an emergency fund as an investor? Well, the first one is simple. You've done all the work building a plan, you've done all the work saving the money, and then you've done all of the work dollar cost averaging into your position. It might have taken you 6 months to build that position. Then all of a sudden, maybe you or a family member loses their job and they need your support. The last thing you want to have to do is sell those positions in order to get by now. Not only will that set your investments back, it's probably going to set you back long term as well financially. Number 2, your emergency fund can actually be a risk-free sound investment itself. Let's say you have a mortgage and attached to that mortgage is an offset account. You could place those funds inside of that offset account. Offsetting your payable interest over the course of a 25 or 30 year loan could literally save you thousands of dollars. So not only do you have an emergency fund, you've now saved thousands of dollars in interest payable on your mortgage. Number 3, it keeps your stress levels down. Knowing that you have a nest egg that will provide for you and your family for 3 to 6 months is just a nice assurity. Not to mention, it lets you negate those thoughts of day-to-day fluctuations within your portfolio. You know that no matter what happens, you're going to be okay and you'll find your way out of it. So in summary, remember, don't panic, dollar cost average, have an emergency fund, and be patient. I want to thank everyone that made it to the end of this video. This is my first ever time filming any type of video for YouTube, editing, anything like this. So I do appreciate you being here. If you enjoyed it, once again, please press the thumbs up button. I am going to be posting weekly videos. Hopefully the content gets better and better and I can get sort of more confident in this seat. So thank you again and I appreciate it. Chat soon.